Through the commitment of our private investors and our public officials and a diverse coalition of leadership, the EDC continues to deliver results for the local economy and community. In 2015, we will unveil a new multi-year economic development strategy to build on the momentum created by our new website and proactive business relocation outreach program. Going global is becoming an increasingly attractive prospect for bringing new wealth into our local economy, and the Braden Area EDC is working to capitalize on those opportunities. Examples include collaborating with community partners to host an international event under the auspices of the United Nations, and recruiting businesses from overseas to plant their corporate flags in the Braden area and export U.S. goods back to their home countries. Meanwhile, our EDC ambassadors, who are very important, are working with existing Braden area businesses to identify the ways the EDC and its partners have helped grow local businesses, and that has been very important over the last few years. Coming the next month, we will once again be hosting the best networking event in the region. I think you'll all agree with that, those who have attended. The Hobnob Barbecue on February 26th at Dolphin Aviation. And we have booked nice weather for that event, so please watch your email for those details. Today is the start of the 99th Manatee County Fair. It is a great fair, if you've never been there, held in resurgent and beautiful Palmetto, Florida. And in a minute, we're going to find out if the economy is going to take us on some kind of ride, either a smooth ride or a thrill ride. And thrill rides can be fun, but we're going to find out in just a second from our guest speaker how that's going to be for this next year. To introduce our guest speaker, it is my pleasure to introduce my friend, Mike Michella, Manatee, Sarasota Area President of Hancock Bank and the 2015 EDC Chair-elect. And with that, Mike Michella.
Thank you, Mark. On behalf of all the associates at Hancock Bank, I really want to thank the EDC for their commitment to us and allowing us to participate in this event for so many years. It really is a great event for the community, the business community especially. And with this type of audience, I just wanted to take a minute and let you know how committed we are to this market. Over the last several years, our industry has really changed, and banking as a whole, and as business people, you have probably seen that. I wanted to highlight some of the things that we are doing that I think you might find maybe different than some of the others. We are committed to the market. We have added additional highly trained and skilled bankers to our teams. While other institutions have attempted to centralize and remove authority from their local markets, we have recommitted to our markets, in effect, recently just changing our structure to empower our local decision makers with more authority. While others have moved loan authority to far-off places to save and consolidating costs, we have increased our local lending authorities every year in the last 5 years that we've been here. So we have a lot of confidence in our people, in our bankers. I want to thank all of you here that bank with Hancock Bank. We really appreciate that business. We look forward to a great 2015. We will remain committed to this market. One of the most recent things that we did is we opened a business financial center in Sarasota to help us better cover that market. As part of that strategy, we've also hired a team of bankers to help us and grow in that market as well. So we've got some new faces, and hopefully after the breakfast, when we hear some good economic news, I'm going to stay positive. 2015 is going to be an interesting year, but hopefully we can help you manage through that. If you have not had the opportunity to speak with the Hancock banker, I would encourage you to mingle afterwards and get to know them. I think you will find that they truly are professional, they are committed to service, they are committed to their clients, and they will go that extra mile, which I think in a challenging time is what, as business people and individuals trying to navigate the challenges we need is people that we can rely on, people that we can count on for good, sound advice, and to help us navigate those challenges. So again, we really appreciate the opportunity to be here and sponsor this event again, and we look forward to working with you in 2015. So regardless of what the economy does, I am excited to welcome Dr. Fishkind back again for the 16th year. He is widely regarded as one of Florida's premier economists and financial advisors. Dr. Fishkind's career began in the public sector, where he worked as an economist and associate professor at the University of Florida. In 1980, Dr. Fishkind became the associate director for programs, the University of Florida's Bureau of Economic and Business Research. During his tenure at the university, Dr. Fishkind served for 3 years on the Governor's Economic Advisory Board. Dr. Fishkind began his career in the private sector as a consultant when he became president of M.G. Lewis Econometrics in Winter Park, Florida. In 1988, Dr. Fishkind formed Fishkind & Associates as a full-service economic and financial consulting firm. We are pleased to bring Dr. Fishkind back to the Bradenton area to discuss what the economy has in store for us in 2015. Please join me in welcoming Dr. Fishkind.
Well, thank you all very much for inviting me back. It's a pleasure, again, for me to be with you. We will get all the slides up and available for you, but first, just a brief disclaimer. As Yogi Berra, that great American sage, said, forecasts are difficult, especially about the future. So, but if with that, you'd still like a copy of the slides, just send my assistant, Mary Eubanks, an email or come on our website. We'll get them posted up for you this morning. That said, over the next few years, I think particularly this year is going to be the best year we've had in the economy since 1999, 2005, you pick it. We're right at the top of the cycle now. There's a set of forces always that both weigh positive and negative. Very strong positives are outweighing the negatives right now. I think we're looking at 4% growth for GDP for 2015. I mean, we just have very strong employment growth, low interest rates, very low energy prices, and rising investment. I mean, what's not to like, right? There's always a few negatives. Global demand is very weak at the moment, and the dollar is very strong as people move from weak economies and from places with more risk to the United States. We've seen the 30-year now and the 10-year trading at historic low points. So obviously there is a move towards the dollar and towards U.S. assets. Good for us in terms of GDP, but problematic for some geopolitical uncertainties. But if you look at the balance of those forces, I think they're clearly positive, and we'll talk much more about that in a second. As we get to 2016, the positives remain strong. I think we'll still have strong job growth, and although rates will be somewhat higher, they'll still be historically very low, and energy prices will still remain very low. But the negatives are sort of increasing in power. That'll slow growth down. We don't know exactly what the impact of the Fed's shift to a more normal interest rate policy is going to be, but over the last 35 years, the Fed has not succeeded very often in achieving the ephemeral soft landing, and that's what they're going to try to do. And it's difficult as we raise interest rates and shift to a more normal monetary policy. The other factor that's going to increasingly come into play is that fiscal policy will become increasingly tighter. The Republicans are in control of Congress and likely to remain so. They may also be in control of the presidency after the next election. But regardless of how that election turns out, I think the Republicans are likely to remain in control of Congress, and they wish to slow the growth of federal spending and shrink the size of government. That's a legitimate aim, but in the short run, 2016, it's not a prescription for stimulating the economy. So as interest rates rise and fiscal policy tightens, the economy is going to slow some, and we'll still have significant geopolitical uncertainty. As we get to 2017, the forces restraining the economy are going to continue to grow. Interest rates are going to be significantly higher by 2017. Fiscal policy is going to remain significantly tight or tighter. Those factors will slow the U.S. economy, certainly. I think maybe 1 3/4%. So, as I like to say, 2015 is a great year. Go out there and be aggressive, make money, do good things. But then you have to be adroit. This is when management is really going to count. As the economy inevitably begins to slow down, we're all going to need to take that into account. Or as the famous developer's prayer says, Lord, give us one more boom, and this time we promise not to blow it. We shall see. Easy words to say. So Florida, 2015 is a big breakout year. I mean, low interest rates, strong growth in GDP, huge job gains in the nation and in Florida. I mean, this is a prescription for very rapid growth in Florida, and we're finally breaking out of a pretty good growth trajectory up to, really strong growth for this cycle. We're talking 350,000 people moving into Florida this year, 2015, over 230,000 jobs, and probably 125,000 housing starts. We haven't seen numbers like these since 2005. So this is really going to be a very strong year. But as things progress, 2016 and 17, things are going to slow down some. We have this collision of the positive forces and the negative forces, with the negatives slowly gaining strength. We'll have strong U.S. job growth even through 2016 and into 17, and housing markets, I believe, will continue to improve, and I believe energy prices will stay down, and there is a pent-up demand for things Florida, and we're starting to see that. You'll see that in the data in just a second when we talk about migration into Florida and the population. So there is significant pent-up demand. But rising interest rates and slowing growth in GDP will inevitably slow growth in our state. And as that happens, we will see some continued weakening. So to start out, here's the United States. Job growth very strong through the fourth quarter. We've been averaging over 250,000 jobs each and every month during 2014. Strongest year for job growth since 1999. So tremendous amount of job growth. No matter what the wages are or aren't, we can debate, why aren't wages rising faster than they are. Wage growth hasn't been very good at all, but yet a lot more people are working, which means there's a lot more disposable income in the economy, and that's the most important factor driving things forward. New claims for unemployment compensation is the best leading indicator about where the economy is going to go. As I told you last year and in years past, if you were going to monitor one and only one economic indicator, this is the indicator to monitor. It comes out every Thursday, this morning, every Thursday at 8:30. Numbers that are below about 325,000 for new claims are consistent with job growth of over 200,000 jobs a month. So if you watch this, and you can see what's happened, and you also see the tremendous gains in employment that are consistent with this falling trend in new claims for unemployment compensation. So as long as that stays below about 325,000, the economy is growing at about 200,000 jobs a month. GDP is growing at 3.5% or more. As this begins to turn, which it will in 16 and 17, it'll begin to signal as the economy slows down. That said, the unemployment gap certainly has come down significantly. Not just the unemployment rate in blue, which has come down below 5.5%, but also the rate for people who want work and who are not yet looking for that work. And you can see both of these categories have shrunk down, but you can see there's still a significant 10%, still a significant amount of slack in labor markets. That's in part why job growth has not led to faster increases in wages, along with globalization, along with productivity and all the other factors that have restrained wage growth, not just in this country, but across the whole globe. Retail sales were the big surprise. Retail sales came out yesterday, and they were reported to be down almost 1 percentage point, which is almost 10% at an annual rate. Much of that was gasoline. Gasoline sales come down dramatically. If you take gas out, retail sales only fell 0.4%. Retail sales didn't fall 0.4%. This data get revised often. They get revised by a lot. It's hard to seasonally adjust it. I mean, how can retail sales go down with all this growth in income? And by the way, consumers are very confident. So consumers are confident, so they don't buy anything. I don't really think so. I don't really think so. I had a lot of job growth. I don't read much into this retail sales number, and I don't think you should either. We had another month. If you look to the left, we have months sometimes where retail sales will turn down. Quirks in the data, but overall, I think the economy is far stronger. As I said, consumer confidence is up. Business confidence is very strong. Business investment is accelerating now, finally, for the first time during the course of this cycle. So I'm really quite optimistic. But trees don't grow to the sky. Rising rates of the dollar make our exports less competitive. It just is a reality, and we're beginning to see the reflection of that in this Purchasing Managers Index, particularly the manufacturing index in blue. Any number above 50 is expansionary. So things have gone from extraordinarily good to merely very good. But that means that GDP growth isn't going to go from 4 to 5% or 5 to 6%. It means that GDP growth is going to be somewhat restrained because of international effects, and you're seeing the reflection of that here in this index. As long as it stays above 50, things are going to be good. I believe that will happen throughout the course of this year and into next. Home sales are the weakest part of this economy. Yes, they've come up out of what I call the valley of death to merely miserable. Both new and existing home sales are greatly and grossly underperforming. Look, here's the average level of new homes sold. Average since 1963 was 635,000 units. We're not even close to that yet. So you can see how much home building and the housing sector has underperformed. If the housing sector performed as it normally does on average during recoveries, we'd be growing at 5.5% GDP. It's worth 1.5 percentage points of GDP loss, that gap between the red and the blue on this chart. Home building will do better over the course of 2015. But it's not going to do great. I don't even think it'll get up to average, but it certainly will do better. We're starting to see some recovery. Interest rates are low. Banks are being a little easier in terms of providing credit to first-time homebuyers in particular. But this sector is going to continue to lag throughout the course of this business cycle. Home prices compared to previous peak. In yellow is the U.S. You can see that on average, U.S. home prices are just 4% below the previous peak. Now, not in every state, like not in Nevada on the left or Florida, the second to the left. So many states, obviously, home prices are well below the previous peak. We're 30% below the previous peak at this point on average in Florida. But what's important is the U.S. is almost back to the previous peak. And why that's important is that when home prices get back up above mortgage rates in particular, but towards the previous peak, and housing markets improve for existing home sales, people are more able to sell their homes and move to Florida. And that's happened for most markets east of the Mississippi River. We get most of our migrants into Florida from east of the Mississippi River. I'm going to come back to this in a couple of minutes, but it's really important. It's what's been driving domestic migration into Florida, and it's been a tremendous force in stimulating Florida's economy. Inflation. There isn't any inflation. People are concerned about deflation. There's no inflation. Whether you measure it in terms of all items, which is green, which is depressed by energy, or the core rate. Take out energy, take out food. There's very low inflation. Here's the producer price index. This is prices before they become consumer prices. There's just not inflation in the pipeline. So over the course of 2015 and 16, I don't really see a problem with inflation. So this gives the Federal Reserve time and scope to move toward a more normal monetary policy. If inflation, by contrast, was rising, it would force the Federal Reserve to move much faster. The Fed is going to move, but they're going to move at a very slow and considered pace in an attempt to achieve a soft landing. There's nothing on the price front that's going to push them. What's going to push them is going to be financial markets. So I thought interest rates were going to go up. That's what I told you last year. And all they did was go down. And even worse, they just plummeted the last few days. So my forecast really didn't work out that well for financial markets, that's for sure. What we have seen in the last, especially the last 90 days, and particularly the last 2 weeks, is this great flight to quality, a movement away from risk, concern about energy markets, concern about global markets, concern about political instability in various places, terrorist attacks. All that adds up to people moving away from stocks and into what is viewed as a safe haven, which is U.S. markets or German markets or the Swiss franc, which went up almost 50% compared to the euro this morning when they unhooked it from the euro. So I mean, there's this level of uncertainty. There's a lot of volatility in the stock market. You've seen the VIX volatility index rise significantly. We're going to live through a lot of volatility in 2015 because nobody's really sure how this move towards normalization in U.S. financial markets and the move away from quantitative easing and an ultimate increase in the federal funds rate is really going to play out. And it's going to cause a lot of volatility. And that translates into risk and some movement in these markets. But I really think these bond markets are tremendously oversold now. I mean, to think that the long-term 30-year U.S. Treasury is trading at 2.4%, I mean, it's really pretty extraordinary and very unlikely to last very, very long in my judgment. I want to talk a little bit about fiscal policy, and I want to talk a little bit about monetary policy, because they really drive a lot of what I think is going to happen in the dynamics in 15, 16, and 17. So here are federal revenues as a percentage of GDP in blue, federal revenues, which have averaged 18% of GDP. And here's federal outlays as a percentage of GDP, which has averaged about 22% of GDP. So you can see that this has been going on for a long time. This is the Congressional Budget Office, by the way. This isn't even Hank Fishkind. Out to the right is the forecast, Congressional Budget Office. So you can see that there is what I would term a structural problem with the federal budget. No matter whether we've had Republicans or Democrats, or who's been in charge of Congress, for almost 40 years, we've been running deficits. We run bigger deficits during recessions. We run smaller deficits during recovery. It almost doesn't matter who's in the White House. It almost doesn't matter who's in charge of Congress. We got a problem. And you can see that no matter what rate of growth we achieve at GDP, we are not going to fix this problem, right? If outlays are running 22% of GDP and revenues are running 18% of GDP, there's no rate of growth that fixes that, right? So what's the problem? How do we fix it? Well, the problem in a nutshell is that the growth in healthcare is going to consume 32% of the budget between now and 2024. Between now and 2024. Healthcare, 32%. Social Security, 28%. Interest, 25%. That's 85% of the whole budget. 85%. Well, there's only 15% left for discretionary programs. You can't fix this by monkeying around with discretionary programs. It's obvious. We have to fix the entitlements that are driving the red and the blue, because they drive the yellow. Social Security, Medicare, Medicaid. Unless and until we deal with those problems directly, we cannot fix this problem. And in the short run, we're not going to fix the problem. I mean, I don't see any political will to fix the problem, right? So what happens? We monkey around on the edges with discretionary spending. Here's the omnibus spending bills. Here's what's happened. I'm not trying to make a political statement. This is just facts. This is just facts. Same people are in charge of the Congress that were in charge of the Congress last year. They want to shrink the federal budget. They don't want to deal with entitlements yet because we don't have a full-blown crisis, and not just the Republicans, Democrats too. So we're going to monkey around with this. The problem for the economy is going to be, we're going to be reducing the growth of federal spending, if not shrinking it. At the same time, we're raising interest rates and normalizing monetary policy. And that is not a prescription for continued rapid growth in GDP. It's a prescription for slower growth in GDP. And that's really where I think the dynamic occurs. So that's what we need to be prepared for, I think. So this is a messy chart, but this is, on the left is the percentage growth in GDP, and on the right, in red, is what's called the spread, the difference between the 10-year bond rate and the federal funds rate, the spread. And anytime that spread gets much below 2%, which is those green circles, look what happens to the blue generally. The blue is GDP. It generally goes down. So as the Federal Reserve raises the funds rate, what's going to happen, that's the short end of the yield curve, what's going to happen is long rates will rise, but not as fast. So the yield curve flattens out, and we all know that higher interest rates cause slower growth in the economy. Eventually, this is the financial reflection of it. So we're in for some slower growth, and that's going to be the way it is, because the Fed is going to raise interest rates. They promised to raise interest rates. If they don't raise interest rates, the bond market will take over, and the bond market will raise interest rates. And we've seen that in 1988. We saw it in 1990. We've seen it in 1980. A number of times throughout our history when we've had this kind of setup in monetary and fiscal policy. If the Fed doesn't move, the bond market does. And so that's what's really going to happen this year. I think that the 10-year is going to move before the Fed moves, as people try to protect themselves from rising short-term interest rates. The Fed has said they're going to start raising the rate in the second part of this year. You'll probably see the 10-year move well before Easter. That's in blue. Federal funds rate in red, that's the only interest rate on this chart that the Federal Reserve directly controls. They're going to move that rate up, I think, in little bitty steps every single meeting. 10 basis points, 25 basis points, in an attempt to slowly slow the economy without triggering a recession. That will cause, eventually, the 10-year to rise, and in green, it'll cause mortgages to rise. Notice that the spread, the distance between the red, blue, and green, shrinks as the federal funds rate rises. That's that flattening of the yield curve that I described to you earlier. And that happens because as short-term rates move towards normal, people believe that there won't be an inflationary problem, and eventually the economy will start to grow again, so that long rates don't move up as much as short rates move. But they all move. And by the end of all this, the funds rate is going to get a little bit above normal. Remember that the normal rate for the federal funds, in red on this chart, the normal average historical rate over the last 30 years has been 4%. So this is a movement towards normal. The problem is it's a big damn movement towards normal. It's from 0 to 5%. It's 500 basis points. Of course it's going to cause the economy to slow down. Mortgage rates are going to rise as well. What this looks like in terms of gross domestic product, I think 2015 is going to be a great year. We're going to have 4% growth. Strong gains in consumption, in housing, in investment. I really think this is going to be a great year for the economy. It's inevitably going to slow some in 16 and 17 because of rising interest rates and slowing in the growth of federal spending and whatever the heck happens overseas. But just the domestic market's going to cause some slowing, I think. So what does that mean for Florida? Well, here's population growth in Florida, 11, 12, 13, and 14. Notice that in blue, red, and yellow, Florida's population growth was about running 225,000. I thought, boy, this kind of looks like the top of the cycle. Why isn't Florida's population growth going up? What the heck is the matter? It should be going up. And it just wasn't until this year, 2014. And the reason is because we did not get a big boost in domestic migration into Florida. Here it is. Here is population growth. Blue is natural increase. That's the excess of births over deaths. It's about 30, 40,000 every year for Florida. Red is domestic migration. Notice that it had been running at about 100. It jumps up to 160,000. That's a 60% increase in red. Legal international migration that we measure has been running about 100, 120,000 a year. So the big change in 2014 was that big increase in red in domestic migration into Florida. Most of that happens because people who live east of the Mississippi River sell their houses and move. And now house prices got up high enough that people said, we can move. We can make the move. Housing markets are strong enough, and that's exactly what happened this year to boost our growth. And I think we'll see more of that in 2015, and I'm very optimistic about Florida for the short run. Here's our population growth, and you can see average since 2000 to 2010 is 281,849. We finally break above it in 2014. And I think this is, as I said, the takeoff year for Florida. I think 15 and 16 are going to be very good years for us. Job growth. Year over year, job growth breaks out above 200,000. That's a lot of jobs. I mean, Florida's generating a lot of jobs. And it's interesting, it's in almost every single sector. If you look at this, we had, as I said, 222,800 jobs gain in Florida, in green, year to date through November of 2014. Notice the strong growth in construction, in trade, business and professional services, and healthcare, and leisure, hospitality. We've had a great run in tourism in Florida, just superb growth in tourism across the state. So even government now finally turned positive, that little bitty green. So every single sector now is positive, and it's pretty well balanced in terms of the Florida economy. So this too is a sign of some sustainability because we're not dependent upon any just one sector for growth. We've got pretty much strong growth across the sectors of our state. So I'm very optimistic. I think in population growth we're going to hit 350,000 for the next 2 years, which is the strongest we've had since 2003, 2004. And probably good that we don't go back to 2003, 2004. I don't know about you. I don't want to go back there. Employment growth also very strong. But as we get into 16 and 17, you begin to see the effects of rising interest rates and a slowing in federal spending as it begins to have some impact on our growth here in Florida. Housing starts will move up significantly out of the 2009-2010 horrible period, but notice that housing starts are way below the previous speculative boom. Also, housing starts are lower than you would expect for 350,000 people. We ought to be generating 175,000 housing starts. We're not going to get there. There's still significant foreclosures, and unbelievably enough, there's still a lot of inventory that's coming back out of financial institutions, and it damps down on starts. So in part in our state, we still haven't completely achieved equilibrium in terms of taking care of on the left that excess amount of housing we got to absorb it on the right. And that's what's keeping starts somewhat lower than would otherwise be the case. Significant improvement also in non-residential construction this year and especially in 16. The reality is we have a lot of population growth and we haven't had a lot of growth in retail space. We're actually in a lot of markets in Florida understored. So I think you'll see a lot of significant increase in retail space and in warehousing and the things that are attached to population. What we won't see, I believe, is we won't see a lot of growth in office. Because of all the technological changes, there's really been a structural change in the relationship between employment growth on the one hand and office space on the other. Used to be that there was a pretty good relationship. That has changed significantly, both in terms of the aggregates and in terms of the amount of office space per office worker, which has gone down from about 250 square feet of space in Florida to about 190 or less. So a lot of changes in the office. That'll be the weakest of the income-performing properties. Let's turn to Manatee County. Look at the growth in Manatee County. 2014, we have almost 10,000 people, my estimate. Now, we don't have the official estimates yet, but 13 was a great year. Florida had great numbers. I think this county is going to have great numbers. I think that about 10,000 is where I think it's going to end up. And I think that we'll have more growth from there, and that is almost as high as 2005. This is one of the few markets that's going to achieve a peak the same as the previous peak without it being speculative excess. And so I'm really optimistic about the prospects here. I wanted to show you some of the characteristics. In the middle is Manatee County. Notice that domestic migration, that green bar, is what most of the population growth comes from in Manatee County. International migration accounts for about 10 to 12% of population growth. Natural increase is about 0. So this county's population growth, which drives almost everything else, is very dependent upon domestic migration. Well, this is going to be a great year for domestic migration. My goodness, we have good housing markets, strong U.S. economy, relatively low interest rates. Housing prices in the eastern United States, east of the Mississippi River, largely got back to peak. This is just the environment that makes any county with green on this chart grow strongly. And so the west coast of Florida is doing well, and this county is going to do very well, in my opinion. Employment growth is always calculated by the state with Sarasota and Manatee put together because it's one metropolitan area. So that said, look at the growth in the green bars for 2014. You see significant gain. Look at the healthcare, reflecting the continued movement of active adult and the expansion of the healthcare industry in this community, but significant growth in construction, business, and trade. The economy is doing very well here. Again, good balance across most sectors. So my forecast is very strong. I think this is going to be a great few years for Manatee County. I think we're going to get population growth that's going to be running 10 to 12,000 a year, which is actually better than the previous peak. I think that there are tremendous amounts of employment that are going to occur in trade, healthcare, construction over the next few years. But again, this as good as this is going to be, remember it will slow. Trees do not grow to the sky. This will have a great couple of years, in my opinion, and then slow some. Housing starts will move significantly higher, but again, there is some inventory here as well. So although housing starts, this will be one of the better housing markets in Florida. I think this is a very sustainable, balanced level, but not quite up to the levels that you would expect. With 10,000 people moving in, we should have 5,000 housing starts. We're not going to quite get that high. Again, some inventory absorption even here. This messy chart has a couple things to say. These are the actual closings. These are the starts, okay? So starts become the little green bars. Those are the closings of the starts. In the dark blue bars is existing home sales. You can see existing home sales are going to move up significantly this year. All that employment growth and all that population growth is going to drive existing home sales up significantly, well above 6,000. And pricing is improving, but notice that the trajectory of pricing, while rising, is rising at a very modest pace. And as we get to 17, it slows further. So the growth in housing prices that has occurred between 11, the bottom, and 14, most of that big rebound is in the rearview mirror. So prices are going to improve slowly going forward from here because the markets are bounced off the bottom and moving more towards equilibrium on the pricing side, even though there's a lot of strength on the demand and closing side. In terms of non-residential, I think we'll see significant increases as well. Again, I think a lot of it's going to be in retail and warehouse, which serves population. I think much less in office, but I think it's going to be excellent. I mean, we're getting to 2 million square feet put in place. So the next few years are going to be terrific for this area, in my opinion. So as I like to say, do well in 2015, be aggressive, and then the hard part comes to be adroit. Remember, trees don't grow to the sky. So we'll get to all the slides, either email to my assistant, Mary Eubanks, or just on our website at fishkind.com, and I'll be happy to discuss any part of this, answer questions, comments, questions. Anybody? Yes, sir, but you got to use your playground voice, real big and loud. Yeah, it's affected significantly. Some of the population growth in this county comes from outmigration out of Hillsborough County, actually. This county has its own sort of dynamics, but it is part of, and you make a very good point, part of Southwest Florida. Southwest Florida is very strong right now, in part because of that strong in-migration of retirees, and in part because Tampa is stronger, and Fort Myers actually has sort of gained its equilibrium. So those things help. I think there's a great opportunity here in the leisure sector that's probably the least developed of the employment sectors, and so there's an opportunity to build that here. But yes, it's clearly part of the regional economy, and it benefits when the whole region benefits, but it's outperforming. This, in terms of the west coast of Florida, Collier and Manatee are the best performing counties on this side. Yes, sir, please. Why don't you stand up and real loud so everybody can hear you, please. Sure. Growth, Cuba and the Panama Canal. I think Tampa has a real opportunity for the Cuba trade as that develops, and that's probably 5 or 10 years out. But Miami just is in political chaos, doesn't really want the trade. Tampa seems more welcoming. There's a real opportunity for Tampa in that regard. The port is strong. In terms of the Panama Canal trade, I don't really think Florida's going to benefit that much from the large ships. The cheapest way to ship something from point A to point B is on a big ship. If you're shipping to the east coast of the United States, does it make sense to take a big ship and put it in Tampa or Miami and offload it and put it on more expensive rail so you can get it to New York? No. That isn't how it works. And so I don't really think we're going to see that much benefit from big ships going through the Panama Canal. They're going to go to Charleston, they're going to go to Newark, they're going to go to Houston, and they're going to go to the stronger ports. There's no reason to be. It's just our geography. You know, we're sitting out in this corner. There's just no economics to really do that. Comment, question from anybody? Yes, sir, please. Right. Yeah. The question is, as the dollar continues to rise and puts us at a competitive disadvantage, I don't believe it's going to be crippling for exporters. It's certainly going to slow the exports down. We've already seen the exports slow because the dollar's moved significantly. There's a lagged effect between the change in the value of the dollar and the movement of our physical exports because of contracts and lag. We're going to see much more of that in 15 and 16. So, yeah, it's going to be a problem for especially highly competitive technology goods. It's going to be less of a problem for agricultural goods, less of a problem for our fertilizer, because there's not that much competition, and because we're so productive, even at a higher dollar price, we're able to produce the commodities at a very competitive price. Now, it's going to have a major effect on commodity prices. And we're already seeing that in the Corn Belt, for example, not only in the price of the commodities, but in the price of the land. So we're going to see that significantly, but I don't think it'll be crippling. And remember that our export sector is small relative to the size of our domestic sector. So if our export sector slips by even 25%, it's going to take off half a percentage point of growth in GDP. That's the sort of dynamics. Excellent question. Thank you. Yes, sir. Yeah, very good question. The gentleman said, you know, lower energy prices are a benefit, but they also cause slower growth in the energy producing sector and in the energy producing states. How will that balance out? What does that mean for us? In broad macro terms, lower energy prices greatly overwhelm the effect of a shrinking energy sector because of the effect on disposable income and so widely distributed. The fall in energy prices has roughly produced a savings of between $750 to $1,500 per household just in gasoline, never mind heating oil, natural gas, and everything else, electricity. So a much greater benefit from the falling energy prices. Tremendous benefit for Florida because we don't produce a lot of energy. When energy prices are low, not only does it help disposable income and spending in Florida, we get more tourists and we get more seasonal residents coming down. So for us, it's all a benefit. But yeah, there are going to be some negative effects from the shrinking size of the energy sector and from less energy investment on a incremental basis. It's going to be a lot less drilling. There's going to be a lot of effect in that regard. It looks to me, and it's very hard to know exactly where prices begin to stabilize, but prices are certainly falling at a decelerating rate. It looks to me like we're seeing a bottom form now at about $42, $44 a barrel for West Texas Intermediate. If that's the case, yeah, there'll be some shrinkage and pain in Texas, Oklahoma, North and South Dakota, Tulsa. But overall, the benefits greatly outweigh the pain. Question, comment? Yes, sir, please. Yeah, it's going to be a strong year for business investment in plant and equipment. I don't think it's going to be such a great year for the stock market. I think there's a lot of volatility, and I don't see a whole lot of upside on U.S. earnings growth. Earnings growth will be strong, but it's hard to move higher than we were in 2014 in terms of the rate of that growth. So in terms of stock market investment, I'd be prudent. Never hurts to take a profit. In terms of the energy markets, globally, the global GDP benefits from lower energy prices. The problem has been the volatility and the uncertainty as that affects the movement away from risk assets into less assets, or less risky assets, is what I mean to say, and into the dollar. I think as oil prices begin to stabilize, which is what I think is happening, I think some of that risk premium goes away. I think there's some equalization and movement back out of those bonds, because being in a long bond situation where the Fed has promised to raise rates is not going to be a good position for most investors, I don't think. Question, comment? Yes, sir.
I was kind of surprised at your Fed funds rate forecast in light of your projections on slower economic growth, low inflation, lower global growth. Why do you think the Fed will continue to that more long-term rate?
I think the Fed has to. I think that if the Fed continues to keep interest rates as low as they are and provide as much liquidity as they are doing now, we will produce another asset bubble. That money is going to go somewhere. And so in a strengthening economy, that becomes a prescription for significant problems on the asset side. And I think the Fed knows that. And I would be very concerned if the Fed did not begin not only to raise interest rates, but allow the runoff of those securities so that the balance sheet shrinks and we shrink down this liquidity in this economy. Because if we keep funding tremendous liquidity, yeah, we could get much better growth in 17, but 18 or somewhere, there's going to be some ugly, ugly asset bubble coming. So I think that's why they have to move. And I think the bond market will reinforce that. I think we see many times where the 10-year bond moves way before the Fed. And I think bond markets will demand some restraint, understanding that there is that potential for an asset bubble. Yes, sir. Sure. That's a very good question. We've seen much lower rates of household formation, much lower rates of new home purchasing, much greater amounts of younger people in particular moving into urban areas and renting apartments and condominiums was the issue. How real is the trend? I think it's real. Will it be maintained at its current rate? Probably not. I think that as the generation who increasingly wishes to rent and live downtown begins to have children, the world will change, as it does for many of us. But I do think there is far less demand from all sectors of the economy for the very outlying suburbs. We're seeing more movement into the more inlying suburbs and into the more urban areas, much more change in taste and preferences for higher density living than we've seen in this country in 30 years. I think those are permanent, but it doesn't mean that there isn't a market for cul-de-sac subdivisions with a gate. There's plenty of that market too. It's like, why is there chocolate, vanilla, and strawberry ice cream? Because different people have different tastes. What happens is the amount of people buying each one of them changes. So what we've seen is a composition change, but not an absolute amount of nobody's buying strawberry anymore. Yes, sir. Louder. Yes, sir. Much higher trajectory for existing home sales, in part because of the answer I just gave the other gentleman. There has been a change and a shift towards somewhat more rental. There is also difficulty for first-time home buyers to achieve the down payment requirements. Now, the federal government's changing the requirements for the qualifying loans, which will help, but still higher down payments than what we've seen. And I think the combination of those things restrains new housing starts and new housing closings compared to existing home sales and movement into rental. Yes, sir. Well, actually, it's a small driver in Manatee County, relatively speaking, is my point. It could be much bigger, but it's relatively a small sector in Manatee County compared to the average for the west coast of Florida, and certainly compared to Florida as a whole. So I think there's upside potential on the tourism side. And that's why I didn't talk about it much, because it's not that big. Statewide, I'm very confident about tourism, and I showed you the tourism numbers. I mean, we've hit numbers 100 million 3 years in a row. I mean, it's just like astounding. Orlando, Miami, Fort Lauderdale, just almost overwhelmed. Not nearly as strong across the Panhandle, which is very interesting. The Panhandle has been far weaker. That's in part because the Midwest has been weaker than the East Coast. And so tourism is, the sources of our tourism are importantly localized. But the markets that would drive Manatee County's tourism are pretty strong. So I think there is some real opportunity. Yes, ma'am. Louder. Playground voice.
Okay, you were talking about domestic migration, and I assume that you're talking mainly about retirees moving to this area. So I was wondering if you see any opportunities for major companies moving into this area and attracting younger people. I mean, that's what I'm interested in. So I want to know if you see any major opportunities in that area.
Sure. I mean, Florida is very cost-effective and competitive. Manatee County is very cost-effective and competitive. And Manatee County, compared to most, has been pretty aggressive. And I'm not going to make any excess flattery, but even-handed and transparent in its permitting, which matters a lot. And so I think that the basics are there. But this recruiting game is very difficult and very, very expensive. So I think all of the parts are here. I think this community's improvements reflect both its competitiveness and its good environment and its good governance. And I think those are critically important going forward. So is it possible? Yes. But it really takes some concerted effort. But certainly the right dynamics are here. Yes, sir, you could ask a question. Good morning. Sure. I think that, that education, especially in the sciences and technologies, critical to the ultimate growth and success of the area, but it's a long-term proposition. It doesn't happen in the short run. This area is not known as a high technology hub. There is a significant connection between defense technology, optics, and computer science, and the kinds of technology that you see in Orlando. There's a significant connection between tourism and the promotion, and then it drives into media and technologies. But there's not much of that here. There's not much of that in Tampa. Is it possible? Yes, it's very difficult to do. Question, comment from anybody? Yes, ma'am. Yeah, the numbers aren't that high. The numbers are okay, but unlike the rest of Florida, I haven't seen a big increase in the volume of tourists or in the volume of activity. There's been improvement, but not compared to the state. So the area is underperforming. It's not because you're not promoting. Venues, investment are really the opportunities. I think I would be aggressive this year, and I think I would be a bit cautionary after that. You're captive in the education area to both private sector dynamics and public sector funding dynamics. And the public sector funding dynamics are probably the scarier one at this point, because the state finally recognized that we've got to invest more in our education. But that's a function of how good the state budget is. And the state determines much of our education funding. So I think I would be aggressive this year, and I think I would be a bit more cautious after that. Yes, ma'am.
Is there any distinction in your job growth between part-time and full-time work?
Yes, I'm giving you just the aggregate statistics on employment, but yes, we have data on both part-time and full-time. The shift has been much more towards full-time over the course of 2014. I think we'll see a further movement towards more full-time. There are structural issues dealing with why employers want to have multiple part-time workers, dealing with benefits and Affordable Care Act. Those structural issues aren't going to change, but the demand for labor will be better. And so we'll see more full-time jobs and less part-time jobs. But that's a real issue. It's a real issue in terms of why our wage growth is so stinky. But those are structural in terms of how do we want to deal with benefits and health care. And that structural piece probably isn't going away this next 2 years. Question, comment? Yes, ma'am.
So you were talking about.
Loud.
You were talking about that you said we could have an increase in tourism in this area. You mentioned something about life sciences. What about advanced manufacturing?
Well, advanced manufacturing is always possible, but it's terribly expensive to promote and difficult to accomplish. So it's not that I would turn my back on it, but in terms of where are you most likely to succeed? More likely to succeed in tourism and sports promotion in terms of bang for the buck than in high technology manufacturing that everybody else is looking for, and there's no compelling reason to be here. Not that one can't be made. Question, comment? Yes, sir. Loud. You gotta be louder. I can barely hear you, man. In terms of the older people, only modest change in the composition of that. Somewhat more urban orientation, but not as much as the press would have you believe. A lot of sort of standard townhouse, small single family continues to be the housing choice for retirees. The other thing that's happening is many retirees are only partly retiring and still working. So proximity to airport is ever more important, and high technology telecommunications, critically important to providing the kinds of housing and services that our retirees are looking increasingly for. Well, thank you all very much. It has been a great pleasure for me to visit with you again this year.
Again, on behalf of everybody at Hancock Bank, I want to thank Dr. Fishkind for his continued commitment to our market and joining us every year. I would like to encourage everybody here to do two things in 2015. So I want two commitments. First off, I want everybody to become involved with the Bradenton Area Economic Development Corporation and its objectives to maintaining our competitive advantages and looking to identify those areas that we can compete and excel to bring more opportunity to all of us in the community. And number two is when you receive a phone call from a Hancock banker this year, I need you to take that call and set up that meeting and allow them to come in and discuss how we can help you have a prosperous 2015. So thank you all this morning for joining us. We really appreciate the participation, and let's all make it a great year.